And that sound means we are live with our halftime report on YouTube. Matt, I've got a little bit of a spin of death. I hope that doesn't mean my Wi-Fi's going out again. How you doing,
No,
brother?
it's on my side as well, Tim. It's just delaying a little bit. For some reason, it came up under the tackle trading market recap instead of the halftime report. I don't know what was going on there.
I don't know. I mean, if I have to have another thing of technology just fail on me today, Matt, I might just turn it all off and like go to the gym. I'm not sure. But then there's tech at the gym I got to figure out. I got to turn the heart monitor on, the whole thing. I don't know. It seems like the world is.
We're never gonna figure out technology. We're just gonna have fun.
We're just going to have fun with it and roll with the punches. Market here, obviously flat mixed. Market can't figure out where it wants to go yet, Matt. What's your first kind of basic reaction to what you're seeing in the S&P?
No, it's the exact same thing we saw yesterday in the market, T. I mean, it wasn't a crazy volatile market, no doubt about that. But when you're looking at the market overall yesterday, I mean, we had a market that came down, came up, came down, came up, and we're just kind of flat today, just kind of trying to determine where we want to go from here.
Cody, if you are here and you are live, can you confirm if we are streaming on YouTube or not? It is frozen.
Yeah, we are streaming on YouTube, and it is under the tackle trading halftime report.
Is it just okay?
It's frozen for me. Okay, I just refresh it, T.
All right, we're good. Hey, man, I just gotta make sure we're all clean. You know, we're ready to roll.
We're clean. We're clean,
It is
bro.
what it is. By the way, Cody, while I've got you, you were in there with the lounge this morning, me and the team, and we were working on, a new format that the lounge that Matt introduced a couple of weeks ago, where we have trader participation. Kind of give us a wrap up, like what was it? What'd you think? All that kind of stuff.
Yeah, so I popped in probably 15 minutes after you guys had started, just to kind of get my lounge fix for the week, and had a student up there, and she was running, and she was learning as she went and going through, and just being able to allow some of the other traders to get in there and figure things out rather than us quickly going through, because we know where to click, we know what to do, we know how to adjust it, look at our risk graphs, like we've just done it so often. So allowing someone else to learn by doing and ask questions, I really like the format, and anyone who is out there that wants to jump in, share your screen, and learn that way, let us know.
Yeah, I definitely attend it live. If you're a halftime crew and a pro member of Tackle Trading, make sure you come and join us in the lounge, 11 o'clock Eastern, every single day that the market is open. And I'm excited about the new formatting. I was talking to the students there, Matt, and I said, if you ever want to know what it is we think you should be working on, look at what we've been working on. 7-step guide to trading. You got to build your daily routine. Tackle 25, cover call systems, bear market survival guide, portfolio protection, things like this, right? And I've got them all kind of working on their courses this week and finishing those courses. So it was a success, in my opinion. Hopefully, that's the feedback we get from students as well.
I just think it's such a good learning environment, Tim. It's such an amazing learning environment when you have somebody share their screen, walking through the analysis, forcing them to go through it and find where they want to go and do what they need to do. And it puts people in a position where they're going to excel, especially if they're in an environment of trust, right? Especially if they're in an environment of people they know, that they trust, that they like, that they understand the same type of rules, the same type of system, and that everybody is there to help. And that's what the tackle community is. And that's what hashtag Team Tackle is all about. It's not just about our reports and putting out what we put out there and all of our shows and everything we do. It's a user experience. It's a communal experience. And I just think it's an amazing learning environment.
Yeah, I'm excited about the whole thing. Quite frankly, I'm excited about our community, the way that it's developing, growing, nothing but good things in front of us. Yep. The S&P is on a doji, Matt. We're above the 20-day moving average. There's literally nothing changed from yesterday's analysis from a technical perspective. And we're going to break down some of the components. But earnings have not been bad this week. I've seen good numbers. I've seen good results. The market's not exactly screaming or anything, but we're seeing positivity from this overall market in general. It fought off that red candle, which could not have happened 2 or 3 months ago. In October or December, when the market was under pressure, even a down day would have extended itself and carried into more selling. We're holding 2,600. You got to say that is of note.
No, it's that 2600 level is so vitally important for this market if it wants to turn into neutral. If it wants to stay neutral, it's neutral right now for me. But if it wants to maintain neutrality and maybe start making a bullish case, you got to stay above 2600. Economically, Tim, we have not seen very good economic news. We've seen we actually got even more slowing growth economic news coming out of the Eurozone. We actually saw recessionary data come out of Japan. Mario Draghi is all about more stimulus to the Eurozone. He's going to delay even raising interest rates and made a further announcement today that he's going to reinvest the payments on the bonds that he is buying out of the free money he is printing back into the market. That's something the U.S. Has done over the last 10 years as well. So we did get a little bit of concern coming out of that. And Wilbur Ross, one of Trump's guys, Wilbur Ross, stated today that we are miles and miles away from a Chinese trade deal. And it's almost with this Chinese trade deal that we get positive news when the market's going down. Right? They tell us, oh, we're close. Wilbur Ross said, hey, we're miles and miles away from a trade deal, and I do believe that. I still maintain that they're going to find some semblance of a deal by the 29th deadline, by the March 1st deadline, but I don't think it's going to be a complete deal. I don't think the market thinks it's going to be a complete deal. So you have a couple, and I want to get your take on this because you have a couple competing ideas coming out right now. You have had good earnings. We had a slow start to earnings. But over the course of last week, Tim, we've had positive earnings reports across the board. Would you agree?
Mostly, yeah. I would say that in general, we are beating on EPS numbers and even the guidance thing, which was a storyline with Apple. Mm-hmm. I haven't seen that much this week, the lowered guidance storyline.
No, and I'm not going to get too caught up in that lowered guidance. There's not a lot of major earnings this week. Next week's a big week in earnings, and we had the financial sector last week, which was a big week in earnings as well. But you have had positive earnings, and yes, can we point out to the fact that they've lowered the guidance, they've lowered the bar to beat on earnings, correct?
Mm-hmm. Yeah,
that happens all the time. Okay, so let's just get that out of the way. That happens all the time. You've had positive earnings, you've had negative economic slowing growth data. So you have these competing philosophies in the market going. That's why when you have these competing things going, you're seeing good news coming out of one segment of the market, i.e. earnings. You have negative news coming out of another segment of the market economically. You have competing ideas, and that is very difficult to psychologically and emotionally understand, especially for new investors, new traders. That's why it's so important to focus on those technical levels in the marketplace, because those technical levels in the marketplace will show you what the entire market is taking all of this into account. That's what the efficient market theory is all about. The efficient market theory states everything known is embedded in price. What we know about slowing growth, what we know about earnings, that's embedded in price. And the market is waiting to start projecting in the future. And so the efficient market theory states everything that we just talked about is in the price. And so don't get caught up in the headlines. Don't get caught up in the Mario Draghi talking. Don't get caught up in Wilbur Ross giving speeches. Don't get caught up in that when the focus should be on the technical levels. And 2,600, as long as 2,600 holds, I'm not looking to be aggressive on the short. Am I going to go pick some stocks that are bearish and shorting? Yes, I'll do that in a bull market too, T. It's about when I want to load up and get aggressive, I need to see the market confirm. I don't need to see a sector confirm. I don't need to see a stock confirm. When I want to load up that shotgun and I want to go hunting, I want to see that market confirm first.
Mm-hmm. Some components on the Ross trade comment dipped, others have been buoyed up. It's kind of a mixed market. In fact, today, Matt, with a doji like that, it definitely feels like a stock picker's market. We talk about that phrase all the time. There are certain companies that are looking very, very good, others that are not. Let's run down the top five.
One last thing here, T, on that doji here. That doji here is happening on a Thursday going into a Friday where there's not a lot of economic reports. There's not a lot of earnings reports. And you got a weekend coming at us that is going to be, I'm sure, mixed with a lot of data coming out of the weekend. You got a Sunday open. And what I'm trying to suggest here, this next couple of days in the market, this is going to be a day trader's market. I'm not looking to get very aggressive on entering into any type of swing trade until I start to see coming into Monday and Tuesday of next week.
Mm-hmm. Top five gainers on the S&P today. XLNX is up 17% on earnings. LRCX is up 15%.
Hold on. XLNX, that is called a breakaway gap. Should continue, bro.
That is a beautiful chart.
That's a breakaway gap. I mean, that's textbook. You have you have neutrality going in from a technical perspective. You have neutrality going into the earnings. You have a positive response to the earnings. It breaks out of the overhead resistance at 95, and then you have that significant number at 100. As long as it maintains above 100, in my estimation, that's going to be bullish.
Yeah. LRCX as well. Lam Research is gapping out on earnings 14%. These are the top two gainers. Different pattern here.
Well, yeah, but again, you have a very similar response to a very similar economic environment, i.e. earnings. You have a very similar breakout, but the difference is you're breaking out, you're running into resistance, right? You're breaking out, you're running into an overhead resistance at 160. You have the 200-day moving average, a downward moving 200-day moving average right there at 166. I want to do anything, and I'm just talking about, you can take LRCX, you can take NLCX. I don't care what the stock is. But when you have LRCX gapping into resistance, and you have, what was the symbol on the other one? NLCX?
XLNX.
XL. And you have to break out where there's no overhead resistance, T. If you had to pick one of the two blindly, you got to pick the one breaking out of a 52-week high, right?
Yeah, buy high, sell higher. I mean, it's counterintuitive for a consumer. I remember when I was a kid, I'd go to the department store. I had to work for my money and I had to buy my own clothes. I'd go to the discount rack, right? So consumer mindset, you're going to want to buy cheap. You want to buy the low stock, the GE down at the dirt bottom. It's the wrong mindset for trading. You buy high, you sell higher on momentum.
I said this over the weekend in Houston. I said, guys, everybody here would rather pay less money for something. You would rather, if you're looking at XYZ stock at 100, everybody here would say you would rather pay 90, right? And everybody's like, yes, I would rather pay 90. And I said, I wouldn't rather pay 90, because for me to pay 90, you just broke a major support level. It's now in a bearish downtrend. And yes, you as the consumer, you got your ability to pay a cheaper price, but you bought it at a different level in a different market condition. As a trader, you want to buy into strength. As a trader, you want to sell into weakness, and you want to continue to do that until the momentum changes. You don't want to ever get to the point as a trader where you're saying, oh, it's up too much. It's up too much. It's up too much. No, Tim, I heard Tesla. Take Tesla, for example. I remember buying Tesla at 38. I remember selling it at 40. I remember then buying it again at 100, selling it at like 120. I then bought it again at like 150, sold it again at 180. Right? And that was all based on technical trends, technical patterns, right? You just continue to buy into strength. And I also remember people saying to me along the way over the years, oh, I wish I would have bought Tesla at 50. Oh, I wish I would have bought Tesla at 100. Or I wish I would have bought Tesla at 200. Or I wish I would have bought it at 250. And all of a sudden it's at 350. And they're like, oh, it's too expensive. Now, maybe, maybe not. But you can't have the philosophy of saying, oh, it's too much, it's too high, it's too high, it's too high. No, it's not. The sticker price is just what you pay. Warren Buffett said it better than anybody else. Price is what you pay. Value is what you receive. And I would much rather buy a stock breaking out of 100 than buying a stock that gapped down to 90. That's just me.
Yeah, I agree. And I love that quote from Buffett, one of his best. And playing on momentum, Matt, is something that you have to train your brain through trading and through back testing. But just, you got to trust your mentors as well. Breakouts are better than just trying to pick a bottom. You don't catch a falling knife.
The breakout is the highest probable pattern in the market.
Yeah, it's one of my favorites.
It's not just one of our favorites. The turtle traders. Remember the turtle traders? The turtle trader system was a breakout system. It was not a retracement system. It was a breakout system in commodities, because the breakout has the highest probable outcome to continue because of the momentum going into it.
I'm seeing extreme strength in the chips here today, Matt. Applied Materials, Western Digital, Micron, even Intel up pretty healthy. AMAT is looking beautiful, pressing resistance, hasn't broken yet, but up almost 8%.
I'll just say this about Applied Materials. It is a fundamentally strong company. It's a good company, and it's a great cover call.
Yeah. WDC is giving me a reversal. Micron is showing me strength. You're seeing chip makers and semiconductors on the backs of, strength in the entire sector. They're all running 8% or so. Intel.
Look at Intel.
I've been saying it forever. Intel above 50 is a great buy.
It is. It is Intel, but now, mind you, Intel does have earnings tonight, so it's not a great buy today, right? We don't want to do that today, but look at Intel above 50. If you see some positive news coming out of Intel, I promise you, if you see a positive earnings report coming out of Intel, there's traders that love Intel. Intel is a darling of the chip makers, and if that breaks 50, you're talking bullish. There's no technical condition that you're not bullish if you break 50.
MKC, biggest loser on the S&P here today, down 12%. Pretty big stock right there. MKC.
Oh, McCormick.
And then Freeport Mac down 9% on earnings.
Wouldn't touch that.
Citrix down, PCG down another 6%. I don't know why they keep listing it on the S&P because they took it off, but
they're done. I mean, they're done. You can't touch that. There was news that came out today, Tim. California, somebody, I don't know the entire political situation of California, but somebody said to PCG they got to start cleaning up their mess. And they said it was going to cost like $150 billion. If anybody wants to touch PCG at 7.5, you're the 8-year-old who touches the fire simply because you're, attracted to it. I wouldn't touch this.
Yeah, like moss to a flame for sure. PCG has been untouchable for a long time, and it's just another lesson learned. We keep talking about some of these stocks for over and over and over again. Guys, we've been calling this one untradeable for how long? I mean, since that news broke, there's no doubt about it.
Anytime you hear Tim or myself say this is untradeable, you can't touch this, it's because it goes against most fundamental technical, economic, whatever the principle is. It just goes against that. As a trader, as an investor, you have to have two things. Number one, you have to have probability. Number two, you have to have an edge, and that means you have to have an edge. Number two, you have to have a positive reward to risk ratio. Picking up something at the bottom off of massive negative news, you have no edge. You have no reward to risk ratio. Same thing with natural gas. You have no edge. That thing is up and down crazy every single day. You have no edge. If you have no edge, there's no trade.
Yeah, and I'm watching our chat coming through here, Matt, and Adam Barr. I love what he just said right here. Glad I collected FCX for earnings, or collared FCX for earnings. Thanks. And I got to tell you, I mean, guys, that kind of protection, if you're going into an earnings, you got to understand how to do that. The new edition of the Tackle 25 that talks about management, Matt, I think it's the most important thing we've done for cover calls in a long time.
No, and if you guys don't know how to collar a trade, go watch the Tackle 25. It is very detailed in how to collar a trade.
Yeah. Took the risk out and saved yourself some money there, Adam. Very, very good job.
When he collars it, he's selling a call option to buy the put option. So basically, he's buying his insurance with the market's money. He took the loss out of the equation. Now what you have is now you can reassess what you want to do with FCX.
I love it. Intel, I want to come back to this one here. It's 49.62 going into earnings, Matt. It's up 3.5%. I cannot find news on why it is running outside of just chip makers in general.
Chip makers.
I mean, when you see a big move the day before the earnings comes out that night, does it give you any pause, hesitation outside, or change your thinking about it?
Are you kidding me? What have I always said? What are you guys doing? Why are you buying stock one day before earnings? I mean, seriously, you don't have an edge.
Yeah, I don't think so either.
So no, and plus, Tim, a lot of that you don't know how much of that is just algorithms trading.
Could be just hedging before the earnings, short covering. You don't know. We don't really know. We do know they have an earnings tonight. Be aware of it. And moving on to the Dow, Intel is a component on the Dow, largest gainer here today. The YM and the ES, they're not discernibly different. I'm looking at the internals here. It's a mixed market today, slightly bullish on the S&P, slightly bearish on the Dow from a relationship standpoint. The down just a hair, little red candle, but kind of a doji, Matt. No real difference to me.
No, it's hanging out. Now it's starting to pick up a little steam, right? Mm-hmm. I mean, I think when I got onto the pre-production show, the ES was about +2 at the time. We're showing about -5. Dow's lost a little bit over the course of the last 15 minutes, but there's nothing here yet.
Yeah, I mean, you have a support on the intraday on the S&P 500 at 2630, which if you do break, you've got some downside. We're sitting right on support right now. The NASDAQ is also showing me relative strength against those other two, actually. Tech, because probably a lot of what's going on with Intel and these chip makers, showing me a little bit of strength. Neutral market under a little bit of pressure intraday, but let's not make that too much until.
I could definitely see day traders shorting under 2630 though.
I do see that too. Yeah.
I guarantee you, there are orders already right there. I guarantee you.
There's a reason why this works, right? It's it is the biggest amount of groupthink there is in the world, by the way, the financial markets. We all see the same thing. We take action.
It's serious. Like as a trader, we all have our different systems, right? Yep. But as trained technicians, here's the one thing we all know: support and resistance.
Yep.
You can argue over trends, you can argue over patterns, you can argue over time frames, but we all know support and resistance. We all see that historically. Now, where we personally put our orders, where we personally put that support level, could a trader say, you know what, I'm putting that at 2631, and another trader saying I'm putting that at 2630, and another trader saying, no, I'm going to short under 2627. Yeah, you don't know which one they're looking at, but we all see these historical levels, right? Yeah. They're all there. Everybody sees that.
Yeah. Other components on the Dow that are up today: Chevron, Goldman, Boeing, and Visa, but nothing of note. Chevron is up 1.7%. I guess that is of note. Relative strength against the rest of the index. The others are all around 0.5% or less. Not a lot of movement. Chevron. Yeah. Large cap earnings on these, energy stocks. I'm not going to touch them until we get through some of that 1st of February. You still got that coming out here in about a week or so.
You still got all energy coming at you.
The real weakness in the market today, and one of the reasons why it's being held back, in my opinion, is these healthcare companies, Merck, Pfizer, and so on and so forth. Johnson & Johnson down 2%. Merck is down 2.5%, 3% actually, and Pfizer's down 3%. When you look at a heat map, one of the best things about a heat map is a picture tells 1,000 words, right? And you quickly can identify where there's strength, where there's weakness. On doji days in the market, those sector relationships stand out even a little bit more.
They do, and I said this in the pre-production, but I'll say it again. The one thing I am seeing today is a little bit of decoupling with the sectors in relationship to the marketplace.
Mm-hmm.
This market has been 10 of 11 sectors have done exactly what the market has done over the course of the last couple of months, Tim. 10 of the 11. The only 11th? What's the 11th? What's the only sector that has not done exactly what the market has done?
Utilities.
It's utilities, right? Yeah. That's the only one. So 10 of the 11. 10 of those, like you look at some of those, 10 of the 11, 3 of them are defensive sectors, 7 of them are aggressive sectors, and they've all done what is exactly happening in the S&P 500. That's that groupthink you kind of talk about in those bear markets. But now you're starting to see today on a little bit of a doji day in the marketplace. Not a lot of news, right? Not a lot of news of note, I should say. But you got healthcare down, 1%. You have staples down 1. What's staples down right now? 1.5%, 1.7%. You're having staples and you're having healthcare. You have basic materials down about 0.5%. So you are seeing a little bit of positive versus negative start to decouple in these sectors, and that's something to keep an eye on over the course of the next week. Because I want to see the market get back to some degree of normalcy, and if the sectors start behaving a little differently than one another, that's going to show you that's normal.
Yeah, I mean, here's the thing. I don't ever want to root for a market crash. I know traders out there do because they can make a lot of money. I'm too much of a softie, I guess, Matt. I know that hurts people, that are not trained or don't have education. I don't want to see it. Mm-hmm. I do know that if the market does crash, there's extreme opportunity. So I would rather have stability. I don't mind this decoupling because maybe that's more of a normal market. The market's not all supposed to move in the same direction all the time.
No, it's supposed to take some degree of skill.
Yeah.
Right? It's supposed to take some degree of skill, but no, Tim, I want to kind of highlight what you just said. I don't think anybody in tackle trading wants to see the market crash because there's people that are not educated that will be really, really, really hurt in that environment. And it's the banks and the corporations that will get bailed out in that environment, not consumers. Mm-hmm. So we don't want to see that. But I'll promise you one thing. Tackle traders will be the first to take advantage of it.
Yeah.
It's not our job as traders to hope that the market does one thing or the other. It is my job as a trader to take advantage of price. That is my job as a trader, and I'm going to perform my job the same way tackle traders will perform their job as traders. It is your job to go out there, make money, assess probability, assess reward to risk, read the price, and trade the price, right? It's not about what you think. It's about what you see, and you trade what you see. Jesse Livermore said that many years ago. But as a consumer in America, do I want to see people struggle? No, of course not. Are you kidding me? The last 10 years, how many times I've bitched and moaned about the central bank because of what they've done to people, right? So in terms of this, yes, we don't want to see the market crash, but we will take advantage of it. And when I'm looking at these sectors right now, and I see a consumer staple sector, XLP, down 1.7% today on a day where the market's doing nothing, that is now confirming on a retracement, you're damn bet I'm going to go look for some consumer staple stock right after we're done.
I see one of the reasons why XLP is down. Cigarette companies, which I did not know were a staple. I guess they are. Altria is down 4% today. MO and Philip Morris also down on.
They've been getting slaughtered the last few weeks.
Downgrades, fourth quarter guidance was down, sales were off, all kinds of stuff. So these cigarette companies have stayed bearish. They're dragging some of that sector lower. Again, the markets are moving in different directions, Matt, which is a good thing. Yeah,
absolutely. Don't get me wrong. I don't mind a stock pickers market.
No, you got to get used to it. And as I'm looking across this whole thing, let's go to the NASDAQ real quick, if you would. Keep working through our process and our checklist. Technology is next. And as we look at the NQ, there is opportunity across all different areas of the market, but one that I like the most is going to be tech. If the market goes back into a bull run or becomes slightly bullish even, I'll be looking for opportunities in tech. During our lounge today, actually, AMAT came up. We talked about it. We looked at Intel earlier. One really good looking candidate is Square. It's a NASDAQ stock, and it's a high growth, high PE kind of company. Salesforce.com, I'm sure, same kind of condition. But Square here, Matt, pressing resistance, nice green candle up 6% today or so.
Yeah, and you are right. It's a high growth company. It's not a company that I would look to invest in, but it's definitely a company that a lot of us trade. If you remember back in 2018, Tim, way back in 2018, it was such a lifetime ago, 2018, Square was one of the most consistent trends we saw in 2018 when a marketplace that was utterly crazy.
Mm-hmm. Yeah, definitely. And I'm reading some of the comments here. Uni, I'll have to come back and check what you're talking about there with marketing and YouTube ads. I think we just want to come in here and have some fun. But Square is going up, breaking out. I do like it. So would you consider covered call here? Because the cover call metrics are off the charts.
No,
and I think it might be a better directional delta type play.
No, that'd be a growth play.
Yeah.
Now, would I consider that if we went into $80 and started consolidating at $80? Yeah, I would consider that. Cover call is great. I mean, but when you're doing cover calls, you got to take into account growth versus cash flow, right? And to me, if you're breaking out here and you're going to scream to 80, I wouldn't want to cover that. I would want to take that directionally. So for me, Square's more of a let me go pop some call options, make some money as it goes into 80. That's for me. For somebody else, Square's metrics are literally off the charts. There's no doubt. I haven't done a cover call on Square. I haven't even prepped a cover call on Square. And I'll tell you right now, you're probably getting close to 3.5 to 4%.
Adam, I didn't see the news on Altria announcing they were going to stop selling cigarettes. I doubt it. It might have been the Juul stuff. I did see some news about them coming out with some stuff. I'm going to have to dig into that, Adam, and get more information on that, because obviously Altria and
terrible decision, Altria, if we go into a recession.
Yeah, that's right.
Terrible decision, Altria.
Who knows what they're doing. NASDAQ is more bullish than the other ones, by the way, from the internal perspective. They've got a 60-40 split on the buy side, sell side relationship. As I look at the top components, a lot of the same ones: XLNX, Lam Research, Applied Materials, Western Digital, you name it. Some stocks that are down, I got to mention one of them here, Comcast, Matt, CMCSA. Anytime.
You just enjoy that.
I am so frustrated with Comcast.
Everybody is. I think it's the number one hated company in the U.S.
It's an opportunity.
Just enjoy it. Just enjoy monopolies.
C'est
Just
la
enjoy
vie.
monopolies. You know.
Yeah. I mean, here's the thing. My Wi-Fi, I pay for the top end Wi-Fi. It's hard lined in. I've got the fastest one they can deliver, and it still skips. And when you call them, they act like you're the jerk.
And yeah, it's still not as good as the Wi-Fi I was getting from my hotel in China.
Correct.
It's serious. It's crazy.
This one's an emotional one for me. I'm going to have to not trade Comcast one way or the other because I know I have a bias on it. And that's probably a good trading rule in general. Comcast down 3%, though. Nettie's down. O'Reilly down 2.5%. SiriusXM down 2%. I have not looked at that stock in a long time, Matt. Give me SIRI if you would.
Siri.
Mm-hmm.
Oh, I've seen a Siri forever.
Have they made a comeback? Well, not really. They're down.
Done the same thing they were doing 10 years ago.
I remember when they were a 10-cent stock, though. I mean, they were destroyed at one point. I mean, that even at a $5 price tag, that's more than what I remember. I don't look at that company hardly ever. Look on the RTY, Russell 2000, relative strength in the Russell today against some of the others. It's a nice little green candle. We're sitting at 1460, holding a little pivot. Is that a bull pullback, Matt? I mean, I was looking at the candles.
No. 2 days does not make a pullback. Okay. 2 days does not make a pullback.
What's the fib retracement percentage?
38% with a minimum of 3 days. My God, man. No, it's like, go buy it if you think it's a pullback. No, I'll tell you, you don't even need to look at the Russell 2000. You don't need to really look at the Dow right now. There are two numbers that you need to focus on as investors and traders right now, and it is 2,600 on the S&P 500, and on the NASDAQ, it is 6,600. Those are the two numbers you need to focus on.
Mm-hmm.
I don't care what they're doing. If the market breaks 2,600 on the S&P, the rut's going downhill fast.
I agree with that 100%. It is the key number. In fact, one thing that I do every day is I watch that level and I'll set an alert to have it text my phone, Matt, if I'm gone, hey, 2,600 failed. I think those alert systems in Thinkorswim can be helpful if you're on the go and you're out and about. RTY.
Let me show somebody how to do it if they've never done it. So if I wanted to get alerted at 2,600, right? All I got to do is right click, come down, create an alert. Say, okay, I want to get noted at or below, we'll say 2601.75. And then that will send me a text message and an email. And if I'm on the go, I can just log in, take some advantage.
Yeah.
You don't have to stare at the screen all day, guys, if you know how to use your technology.
100% agree. You shouldn't stare at it all day. You should find a way to be efficient with your time, no doubt. Move on to the dollar, Matt. You were talking about the dollar potentially moving into some bullishness. I'm currently neutral myself, but that's a beautiful candle, and you've got to respect that pivot failing.
Oh, the candle completely changed the trend. You broke this pivot. You're above 96. You broke that pivot at 96.5. You're now back into neutrality. And Tim, not only are you back into neutrality on the dollar, and a lot of this was Mario Draghi's comments and the slowing growth coming out of the world. But and real quick, this is why you short under 96, not above 96. I just want to make sure that's clear. But when I was looking at this from a currency perspective, when I was looking at the cross pairs, I'm looking at this on the US dollar, Japanese yen. If that breaks 110, that's tradable on the buy side. For the first time against the yen, you would have a legit tradable signal since all the way back here. Since that one in November, okay? And I know that one in November because I did the Forex report and said that's going to go up to 114. So 110 here, if you break out of 110, that's tradable up until 111 on the buy side. That's number one. You look at it against the Swiss franc here. Dollar breaks out of 1. That's a very important barrier for the dollar against the Swiss franc. You look at the dollar against the CAD, you break back up above 134, projection has to be back into 136, okay? So what you're seeing on the dollar right now, if you just look at it from an index perspective, saying, oh, we still got a ways to go before 97. We got a ways to go before we break out of those levels. But you are setting at a very important resistance levels on a lot of those currency charts that if the dollar continues to appreciate into 97, a lot of the people that were short dollar against the yen, short dollar against the CAD over the last couple months, that's going to be driving that market above 97 and perhaps potentially break out into that 97.70 barrier. So keep an eye on the yen, keep an eye on the CAD against the dollar, and keep an eye on the Swiss franc against the dollar at that one level this week.
Biggest pip movements today are out of the Aussie and the euro against the dollar. They're making some pretty good moves, and a lot of those setups are definitely going to come in. Crude oil is at $53 a barrel, still sitting in between those two ranges, 50 and 55. We talked about it yesterday. Beautiful description of the K trade by Coach Frank, I think, on Twitter.
I saw that on Twitter.
Yeah,
well done, Frankie.
Yeah, really cool. And we're still in the same spot. I know it's up 1%. It's got relative strength against some of the market today, but broken record. I mean, it's in the middle. Until you break out one way or the other, you're neutral.
You will literally have me and Tim analyze crude oil for about 5 seconds every day until 50 or 55 is broken.
This is interesting though, and I don't know why this is. Brent is not up and crude is. Brent is, give me the, what is it? BZ, I believe.
It's whatever.
Just a percentage difference, still a little doji candle. Yeah, usually they are almost in lockstep percentage by percentage, but there is a little bit difference there. Gasoline up, heating oil up, natural gas is up 5% here today. Found support, $3, Matt. I actually think that there is a chart here to analyze. I still don't touch it. I got to see more. I've got to see stability for a period of time, right?
The only person touching this is day traders, Tim.
Yeah,
that's it.
Well, put sellers. I bet there's some aggressive put sellers out there that are doing it.
Oh, go sell your 3 delta. Enjoy getting your ass handed to you.
Hey, I'm just saying.
That's fine. I don't see an edge there. So
it's not it would not be the product I would trade. I'm with you 100%.
Listen, I know you're getting a great return on investment. I know you have great probability. Tim, you can come here to the chart here and I can go down and say, give me a 32-day contract. Let me sell this delta right here. Let me sell a 5 delta, $2.45. Let me see if I can convince you of this, okay? I'll just show you on the one contract. Now, when I sell a 5 delta, Tim, I got a 95% probability of finishing it out of the money. Currently, you're getting about 4% on the money. No, you can't do that.
Yeah, I think there are probably different ways you can approach the market right now. There's no doubt. And, daily routine wise, that's where we're at. Give me a quick look at Bitcoin, if you would, though. We haven't looked at this one very often. It's not a part of our daily routine, but it's now stuck in the middle. The one thing I want to point out about Bitcoin is that we had the long consolidation for most of 2018. And when it broke down, it screamed to the downside. We are now developing a very similar type of consolidation. And I would be very well aware of that 3120, whatever that support is, probably 3,000. If you are a Bitcoin trader, you're probably in the wrong show here today. You're welcome to stay. But we haven't focused on this in a long time, Matt. It's become untradeable as well.
In 30 years from now, when Bitcoin's trading at 1,500, and it's been trading at 1,500 for 20 years, the fanboys of all cryptocurrency will all be pointing to the next fad about how it's going to improve Bitcoin, and I don't care. I'm going to cash flow. I'm going to compound. I'm going to pop calls and puts. I'm going to do what I do. I don't need to touch this crap.
Yep. We are now going to move into our feature here today, going into the fourth quarter, and at this point, I always am reminded by our producer and coach Cody to ask for a like and a share. And let's get the word out there. Tackle Trading's halftime report. Each and every day, we're coming in and breaking down the markets. The one thing we wanted to do today, Matt, is talk about how to use a put option and to protect yourself, either in the portfolio or a call or whatever it is. And we wanted to show some of that mechanic. Kind of explain that, if you would.
What I've done here, guys, is basically I'm simulating the environment of last November, right? And what I wanted to do is I wanted to simulate this based on what we talked about yesterday. We talked about yesterday how this was a perfect opportunity to add insurance to a long-term environment, to a long-term portfolio, given the technical condition that we were looking at. And just to kind of show you that very quickly, if we were looking at the S&P 500 We were looking at it on a weekly chart, and you had this little retracement coming back up into here, right? And we said, okay, based on this, we see that hurricane coming at us. It may hit us, it may not. We don't know. We don't know what the future holds for certain, but we do know that the risk has increased, and we do know that when you buy insurance is after retracements. You don't buy insurance when the market is screaming down. And Tim, can you explain to our team tackle why we do not buy insurance as it is screaming down?
Because you'll have to pay more.
It's simple.
Our mother and our family, actually, we come from a long history of being insurance, providers. Our family had insurance agency. And imagine, Matt, if you lived in a world where you could buy car insurance whenever you wanted to, instead of having to have it all the time. That's kind of the market. That's what the financial markets are. Yeah. You can add insurance when you choose to, instead of having to carry it. And waiting until it starts going down is like waiting till it snows outside and then calling for car insurance. They're going to make you pay more. The premiums are going to go up because the risk is higher, right? Yeah. So it's just the cost relationship.
It's how insurance works in absolutely everything. Tim, if you have 3 DUIs on your record, which you don't, but if you did have 3 DUIs on your record and you have 14 speeding tickets, and I have 0 DUIs and I have 0 speeding tickets, and I'm a law-abiding citizen, they're going to make you pay more than they're going to make me pay, simply because of probability.
That's right.
If you and I live in South Jordan, Utah, nothing ever happens in South Jordan, Utah. It's a really boring state from a natural disaster perspective. We don't have to pay as much in insurance here in Utah as, say, somebody in Florida does because of hurricanes and that. It's just the way all insurance works. If the probability is greater of risk, insurance premiums go up. And so as the market is coming up, the volatility is going down. So as markets go up, volatility is coming down. As markets go down, volatility typically goes up. As volatility is representative of an option Greek called Vega. So Vega goes up, value of options go up. As Vega goes down, value of options go down. So as the market is screaming down here, the value of those options are increasing. And so you're paying so much in premium because you're the last one to buy insurance. But as the market is coming back up, you're saying everybody in the market's like, oh, it's going to go back up. It's going to go back up. Everything's good. Everything's gravy. Nothing to see here. Just go buy everything. And so the value of options, the value of those put options are decreasing. And so it's at that point where you're like, okay, technically we're now in a bearish retracement. Technically we're coming into that resistance level. So technically speaking, I want to add some insurance, because the most likely scenario isn't the market's going to go straight back up. It's going to come back down, go up, back down, go up. So in terms of this is a perfect opportunity to add insurance to the portfolio. So what I did, T, is I added 100 shares. I basically simulated 400 shares in the S&P 500, right? Mm-hmm. So if 400 shares in the S&P 500 is simulating right around, what would that be? 112,000, somewhere around there.
Yeah, 260 times 400. Yeah, a little bit more north of 100K. So
obviously north of
about 110K, right?
Okay, so whatever it is, don't care.
Yeah,
it's 110, 111K. All right.
Well, the BP effect over here says 55.7. Just double that.
Yeah,
that's exactly
double that. 110 and a half. So we'll just say 110. Mm-hmm. So basically what I did was I said, okay, I have $110,000 in this retirement plan. In this retirement, could be a 401k, solo 401k, could be a SEP IRA, could be a Roth IRA, could be a traditional IRA. It could be just a margin account that you have long-term investments in, right? So all I've done is simulated a $110,000 portfolio in the S&P 500, which would be very similar to a retirement account that is invested in mutual funds with $110,000. So here's what I'm looking at. Technically speaking, okay, we're currently at 278 on the marketplace. It certainly could go back up to 292. So let's go here and we'll add our price slices. So let's say it goes all the way back up to the current resistance of 292. Just give me a second. Let me change that. So if the market recovered the complete drop T, we would recover back up $5,400. So if the market recovers this entire drop that it had in October and November, and we're getting that snapback rally in early November, you're going to make back $5,000 that you lost in this movement to the downside. So if the market goes down to the next level of resistance, and we knew where that next level of resistance was, is right here at about 260. So if the market goes down to say 260, that next level of resistance, you're going to lose $7,400, right? So if you're looking at that from a trader's perspective, you have an inverted reward to risk ratio. You have more risk than you have return. And technically speaking, you were forming a bearish retracement, which is probability has to be down to the downside. And we talked about that. If you want to go review our November and October, halftime reports where I called the Russell 2000 bearish in October, go review those. But you were seeing a technical pattern called the bearish retracement. And at that point, Tim, I promise you, we probably said this is a good time to add insurance, the same way we said that yesterday. This is a good time to add insurance. So what I can do here as a trader is I can come out. Now, there's a couple of different ways to do this. If you are that long-term investor, like my mom, my dad, long-term investors, they want to buy insurance for a long time. They just say, okay, I'm going to go buy 500 days worth of insurance. Okay. And there's nothing wrong with that. There's nothing wrong with that. But as a trader, I know the markets don't just go down. They go down, they go up, they go down, they go up, they go down, they go up. So as a trader, I don't need to buy that much insurance in terms of time, because I'm going to close my insurance the next time it comes down into support. Does that make sense?
Mm-hmm.
Okay. So as the market comes down into support and the projection changes, I'm going to uncover, I'm going to unhedge, I'm going to remove the insurance from the equation, because the only thing that I'm protecting here is this next movement to 260. That's the only thing I'm really protecting. Now, can it go under 260? Absolutely. And if it does, I'll be very happy I have that insurance. But I want to cover that next drop down to 260 is what I want to do. And then obviously, if I have the insurance and it breaks that support level, I am very happy I have that insurance already, because I bought insurance at a cheap price up here instead of a very, very high price, as the market is in fact breaking that 260. So what I'm going to do is I'm going to come to the market and I'm going to go down. Now, T, there's a couple different ways you can do this as well. If you're collaring the trade and you're selling 40 delta call options, I would buy 25 delta put options. That's what I would do. If I'm covering from a short-term perspective as a trader, I might go buy an at the money put option. Okay, if I'm covering as a short-term trader. So what I'm going to do is I'm going to come to at the money, current stock price 278. Okay, I'm going to come to 279 here. Now, if you're looking at this on the risk profile, we own 100 shares of the spiders. I'm going to add 4 put options. Okay, I'm just going to have 4 put options. I have 400 shares. I'm going to add 4 put options. Now, what that does is it basically removes some of the gain to the upside. Okay, some people would think about this as a cost. I'm spending $4,000 to protect $110,000. I don't see it that way. I see this as an allocation. I am taking $4,000 of my portfolio and I'm allocating it to protect the 110. So it's like I'm doing a spread here, basically. That's kind of the philosophy, the mindset here. But as you can see, what happened? Well, our return to 292 was going to be 5,400. Our risk was going to be 7,400. By protecting that, all of a sudden, I now have a positive return versus risk. I've given up a couple $1,000s of potential gain, right? I've given up a couple $1,000s of potential gain, but I've covered $5,000 of potential risk to the downside. That's option number 1. Option number 2, if you wanted to be aggressive in your insurance position, is to basically double your contracts. And that's what we call a ratio type trade. So a ratio trade is when you're buying more than what you are than what you typically do. And so a ratio trade basically states that all of a sudden you create this V-shaped risk graph, right? Which means now what you can see Now, obviously, volatility is going to impact this reward to risk ratio. Time will impact this reward to risk ratio. But what you now see is if you get any movement one way or the other, you do have a positive outcome, which means you're taking out the risk. Where you don't have, where you will lose money on this, and you can see you're making $104. That's not accurate, but where you do lose money on this is if the market stays sideways and basically time ticks down out of the insurance you're having. So what I'm going to do is I'm going to ratio this trade. I'm buying 8 put options to protect the 400 shares. And again, you can do this non-ratioed as well, but I'm just showing you the aggressive stance at it. Now we're going to fast forward a little bit in time, just to show as it comes into 260. So going back to the chart here. Now this is where we were at right there. This is where we're at. You have that bearish downtrend coming down on the short-term trend. You're popping back up into that 2,800 on the S&P 500. You're adding insurance based on the fact that it is a bearish retracement. Now, as you can see, the market over the course of the next couple of weeks came right back down into that 2,600 level. So here it comes back down into that 2,600 level. You're holding the insurance. You're holding the insurance. You're not going to get rid of it. You're holding the insurance at that point. Okay, and so right here, let's go project that on 1210. So now we're coming into this and we're saying, all right, let's fast forward to 1210 to show you how this works. So we're just going to fast forward to 1210 here. And it takes a little bit to, you can see it up here, pre-buffering. This is the on-demand program through Thinkorswim. So as you see it, it says on-demand now. Now we're back here. Let's go look at the chart. Okay, so it came down in price. It's hit that 260 mark. And you're saying, okay, my loss was going to be $7,000, Tim. Okay, so now I'm down $4,000. Oh, wait a second. Oh, I didn't actually. See, this is where, Tim, you're going to be like, Matt, listen, you didn't actually add the insurance there, buddy.
On the on-demand. I love this platform, by the way.
It's so good. It really is so good.
Yeah.
11.5. Yeah, I just got to go back to 11.5. I didn't actually add those put options. I'm like, oh, that's not right. I was just showing them on the risk graph. So let's go actually add those put options on the spiders. All right, and we were doing 278, I believe. Actually, we'll just do, yeah, we'll do 274 here. Just add them. And we'll play it up. Okay. Now you can see it on the risk graph. And let's take out that one. There we go. Okay, so now we're long 400 shares. We're long 8 put options. We have the March strike price. We have our V-shaped risk graph. Now let's go to the end of that week on the 14th. Now we're cooking there, bro. I forgot to add the ingredient of the put options. It doesn't work if you don't add the put options. So we're pre-buffering here. Okay, now let's go to the monitor tab. Now, I'm down $6,000 on my S&P 500 trade. Kind of what we talked about, what the projection was, right around $7,000, right? So we're down $6,000. But what is our put options done? Our put options have increased by almost $4,500. So we've offset $4,500 of that risk to a net loss of $2,300. That's what that insurance did. Now, you have a decision to make. We're approaching that support level here. Do you want to pull the insurance off? You have that decision to make.
Yeah.
It worked how you wanted it to work.
Well, and you do have that simple decision, pull it off or not, right? Or you could just unwind half of it, or there are a lot of different subtle things you could do.
I think that what you just said is the best one.
Yeah. And
that's why I do like ratioed at first, because that allows you to unwind half the position, right? Lock in profit on half of the position. So let's go do that. Let's go right click, create a closing order. Let's lock in on half. And I'm not doing any mid price or net. I'm just whatever the price is. Okay, so we locked in half of our position here. Right. Now, you see we only have 4 contracts. We locked in half our position. That's done. So if the market does go back up, we locked in profit. We still have half the trade on. So let's fast forward another week.
Mm-hmm.
And let's go to that 20. Let's go to that 24th day. We know what happened on the 24th. Okay, so now you see the market coming down, down, down in the next week. And pre-buffering. All right. So now, Tim, we would have lost $16,000 on the retirement account. In that week, we had another $10,000 in loss on that retirement account. But what did our insurance do? It's up a grand total of $10,000 total.
Mm-hmm.
We've covered a majority of the loss. We've covered $12,000 of the loss. If I would have kept the ratio on, you would have made money on.
It would have profited. Yeah. Yeah, for sure. But these are the kind of things, by the way, that you can learn in on demand and in back testing, and you can simulate, and you can go back and you can really think through it and work through it. It's incredible.
The on-demand program is such a good program. It's not a one-to-one, obviously. When you're doing a spread, I mean, it might take some time to get filled, so the fill rates are a little different. But it's a wonderful way for you to go back and test how things would work, right? Sure. It's a wonderful way to, and sometimes when I'm like working one-on-one with somebody, I'll simulate an entire 50 trades over the course of a 3-month period, and we'll make decisions day after day after day after day after day. It's just a wonderful environment to practice in. It's a wonderful environment to learn in. It's a wonderful environment to test new ideas, new strategies in. And it simulates a live environment, but that's how the protected put option works.
I love it. And, in my opinion, if you can control risk, you can do this forever, and I think that there's not enough training like this right here, Matt, where people talk about how to protect themselves and how to hedge and how to understand market dynamics in that regard. If every investor out there just took the time to learn the protective put and caller, you could trade in your retirement account with much more confidence, so I love it. Very, very good job.
And let me respond to Sam real quick. Sam says, so you're basically saying swing trade the insurance. As a trader who can be aggressive in the marketplace, yes, that's exactly what I'm saying. It would be a swing to position trade, depending on what you're trying to accomplish there. But yes, that would be a swing to position trade. If you're an investor that doesn't have that trader skill set, and you just want to protect what you've worked so hard for in that retirement account, I would not swing trade that in any capacity. I want to position trade that. Given the fact that we're at the top of the market cycle in a rising interest rate environment, what I would do is I'd go buy 2 years worth of insurance at a 25 delta is what I would do.
Mm-hmm. A lot of stocks flashing here.
Honestly, I would not touch that insurance. I wouldn't touch it 1 second. I wouldn't try to manage that insurance. I would basically say, if I lose that insurance because the market goes up, I don't care. Let the insurance work. And before you start getting into well, Matt, you'll lose money on insurance. Well, guys, you lose money on insurance every month of your life. You don't actually want to use your insurance. You don't actually want to die, so you use your life insurance. You don't actually want your house to burn down so that you get to use your home insurance. You don't want to get in a wreck, so you use your car insurance. You want the insurance there to give you peace of mind. You want insurance there so it takes out risk of hypothetical scenarios. You don't actually want to use your insurance. You want the market to go up. You want your long-term investments to do good. You want to compound cover calls. You want to collect a dividend. You don't want the market to crash, but you will be very happy that if the market does crash, you have that insurance at the top of the market that gives you the ability to sell the market at the high price instead of taking the loss.
Mm-hmm. Oh my, what a day. Guys, if you got value out of today, make sure you give us a like and a share here. Obviously, that's really amazing training, very important stuff. I loved it, Matt. I will say this, I'm watching the market as we're going through this. We're testing that low, 2630. We dip below it. We have come back. You're in the middle of the day with light volume, and it's hard to really see anything and trust it for now when you don't have a lot of volume, a lot of activity. But that is a break of support. I think it is something that is of note, and how we close is going to be very important here today, in my opinion.
You give me over under 2630, throw a dart. I don't think you're going to see a lot of action today.
I don't either. Corporate earnings have been fairly strong as we've gone through the week. The storyline of the month is going to be earnings until the end of the month. When we get to the next Fed meeting, that is not tomorrow. You've got a few key corporate earnings here tomorrow, Matt. We did look at Intel. Ford beat yesterday. Comcast beat yesterday, but they're down today. Texas Instruments. I also see DHI.
Well,
DHI is tomorrow.
DH Horn. By the way, if that was not earnings tomorrow, that's a great bullish retracement. And Tim, that's a textbook bullish retracement. And I'm just going to tell you why to just understand your little snide comment on a 2-day pullback in the Russell 2000, trying to get my blood boiling there. That's a Goldilocks retracement.
See, that's what gets Matt's blood boiling, is when you bring up anything to do with his analytical way of processing technical analysis. A pullback is not 2 days. It is more than 2 days.
I am a rules-based trader. I am not going to apologize to him for being a rules-based trader. You don't buy 21, 23% Fibonacci retracements. Come on, those are high bases. What are we doing?
Hey, real quick, if you like that setup, check out Toll.
Toll Brothers looks great.
Toll. We looked at Toll yesterday. I love the setup on Toll as well.
Yeah,
that's a setup too. That's tradable. That's Toll Brothers, good company, fundamentally strong company, TAC 25 company. Definitely understand. If you wanted to be an investor, wait for it to get out of 36.5. But yeah, I like that setup on Toll too.
Give me a chart on AVGO if you would. Broadcom AVGO option report breakout, Matt. Yep, and you did break 260 here for a swing trade.
Yeah,
it was a triple top breakout.
Yeah, I would personally wait till 270, but I see the breakout 260. Definitely a trigger there. Definitely a trigger there.
Bed Bath and Beyond BBBY, real quick. Kind of high basing, not there yet.
Not there yet.
And
by the way, I just want to say something, Blake, too. Blake says good stuff. Always learn something new about trading. Like, I'm 13 and a half years into this business. I've created trading systems. I've taught hundreds of thousands of people around the world. I still learn something new every day. There's a reason every day Tim and I talk for hours upon days about trading and investing and, back testing and all this stuff. I mean, it's just this industry, like every other industry, is a constantly evolving industry. I remember that first system I learned trading. It was a MACD crossover system. Back then, it was great. I loved it. Right. All you had to do is wait for, a blue line to cross a pink line and you were ready to rock and roll. Right.
Yeah.
But the market changed and the market evolved. And as a trader, if we're not evolving and changing with the market, it's going to run us over by the people who are always changing and evolving with the marketplace.
Yeah, I agree 100%. And as markets change, you have to change with them, which is why critical thinking and collaboration and team are so important. Matt, we got Cash Flow Club tonight. We got a lot going on. Here's my only real call to action for everybody out there. If you've not finished the 7-step guide to trading, go and do that and get it done on the course on the site. Okay, I love that new course.
Also, Tim, it's a great new course, but also if you know somebody that could benefit from this, benefit from the 7-step guide to investing, that is a product that we put out there for everybody, right? We do some amazing premium systems and advanced systems for our pro members, and we do so much in terms of scatter reports and shows and whatnot. But that 7-step guide we did was to really put it out there for the masses. And so and obviously for our pro members that have seen that, you see me pitching tackle in the 7 steps. So take that for what it's worth, but share it with somebody. If you like it and somebody else needs it, share it with somebody. That education, even that 2 hours can help somebody, see that perspective and maybe take a step in that right direction. So definitely help us spread that good word out there.
My charts are spinning. My Wi-Fi must not be working great. We're done. Great job, Matt. Great job, Cody. We will see everybody back here tomorrow. Halftime report.